Hey everyone, and welcome to another interview on the Good Soil Investment YouTube channel. Today we're joined by Eric Markowitz from Worm Capital. Eric, it's a pleasure to have you on here.
Yeah, thank you guys for having me. Hey.
Yeah. So for those who maybe are not as familiar with Worm, could you give a kind of an overview of what you guys do and your position there?
Sure. Yeah, I'm the director of research at Worm Capital. Worm Capital was started by Arnie Alson, who's our CIO and portfolio manager. The long-only strategy that we launched in 2012, so that's coming on its 10th year. We launched a long-short strategy in 2017, so that's entering now its 5th year. High level of what we do, we look for really the best businesses in the world that we think have the ability to compound out at significant rates over the long term. We're sort of a buy and hold mentality, but we're highly concentrated in truly our best ideas. Over the next 10 years, we think it's a pretty fantastic opportunity set for, in general, disruptive innovation and the types of business models that we're attracted to. Companies that can scale globally, that have huge addressable markets, but we're really focused on just a few core businesses that we think can ultimately grow to multiples larger than they are today. So that's the high level. I'm sure we can drill into specifics, but it's good to be chatting with you guys.
Yeah. Pleasure to have you on here. Eric, I think, you and I first connected, before I had even joined Good Soil, and I was just surprised at kind of the clarity of thought that you have. There were a lot of things I was seeing in the energy industry, which, very few even insiders within that industry didn't seem to be picking up on it. And you've just kind of, you seem to be incredibly forward thinking and I think connecting the dots in a way that is rare among anyone, but probably especially among institutional investors. So, in a world where I think probably most hedge funds are trying to short Tesla and short a lot of these, disruptive, overpriced names, I think you guys are doing quite the opposite and are kind of doing ground up research. So I think we feel like kindred spirits in that regard. A few rogue hedge funds out there, fighting the long fight on some of these growth names.
We've definitely been in the foxhole together on certain. But yeah, I appreciate it. That's a very kind introduction. I hope I can do that introduction justice throughout this conversation. But I come from a non-traditional, non-finance background. While I've been an investor for over 6 years now with Worm, I started my career as an investigative business journalist, and so I think I maybe just approach research a little bit differently than some of my peers. We're very focused on the sort of fundamental side and connecting the dots, as you said, across industry, really looking at businesses of who's leading them, what are the customers saying on the ground level, really what's happening, as opposed to, just like a simple DCF and walking away after 10 minutes after doing kind of the bare minimum, which I think some people may be guilty of, not all, but certainly some.
Eric, I was one question. What's it been like? I mean, we've been a fund, taking investor capital for about almost a year now. Not as long. You guys have been in the business. You said 10 years or so, or for a while, and you've been a long-term bull on Tesla for a while. As a hedge fund. For a long time. When I could only imagine. It must have been hard to be bullish on Tesla as a hedge fund manager, for years there. You probably were almost like laughed out of the room at times. I mean, what was it like talking to other hedge fund managers about Tesla or institutional investors about Tesla? I mean, you must have gotten met with a lot of pushback. What was it like back, for years?
Yeah. The connection on the internet's not all that great, so apologies if I'm cutting you off here, but
no, you didn't.
Yeah, it was almost okay. Yeah, I would say for a period of years. I mean, we really started building our position in Tesla in 2016, and I remember going to an institutional investor conference with one of my colleagues, Dan Crowley, and we're sitting down. We have Worm Capital, our firm's name up. Our biggest position is Tesla. And, we're talking to pension funds of, like a Kentucky teachers retirement system. And they're looking at us like we have 3 heads. So absolutely, it certainly has not been an easy position by any stretch of the imagination. And I think, frankly, the moment it gets easy, that's when I would get concerned. I think that for there to be a good investment, there has to be some natural tension in the perception around a company and its potential opportunity. But yeah, I mean, I can tell dozens of stories just about the phone calls that we've had where allocators just would break down laughing, just really
like literally laughing, just like actually wow.
Yeah,
like what, you're long Tesla?
Right. And look, I mean, I think all of that, while in the short term, can be painful, and that's certainly true across all. I mean, I remember hearing Arnie talk about, he was long Amazon in 2013, 2014, and that was a similar painful trade. I mean, he talks about pretty publicly, all the New York hedge funds out of, from, I'm not going to name names, but there were certain big, well-respected, well-known hedge fund managers that were actively short these companies, and were making it very difficult to, talk to clients, and kind of keep the position because it was so contrarian. I do think as an investor, your first principles mentality has to be do what's right for your partners and what's right for yourself. And we always stick to that standard. And so when we believe that we are right in a position, we won't sell because, consensus tells us we're wrong, or, we won't trim because that would look like the smart thing to do. We truly do things kind of on a first principles level. We're really with the intention of benefiting our partners over the long term. And I know you guys are new to this business, and I would just say up front, I'm super thankful to have the partners that we have, because they've stayed with us for the long term, and that's who I think it's essential to work with in this type of business.
Yeah. So you mentioned, your concentration levels kind of being higher than maybe a lot of other hedge funds out there, and not wanting to trim just because that's what, most managers would do in a situation. So how do you approach that question of concentration, and how has that, I guess, helped you or hindered you in the last couple of years?
Yeah, I think we view concentration in some ways as a protection against risk. I mean, when you become overly diversified across, 15, 20, 50 names, you're inherently diversifying your risk while limiting your upside. And so when we stay concentrated, we do so in large part to avoid investing in companies with a lower probability of success. So, we also just let winners run, sort of philosophically. I think that there a lot of the strategy that we employ is not artificially closing off a position when it's fundamentally succeeding, from a business perspective. And then, long term, I mean, this is a game of probabilities. I know that you guys talk about this publicly. Hopefully you'll come on my podcast and talk about probabilities and options and all that. But, there's always the risk when you pull capital out of a position and reinvest it. It introduces risk, and the reinvestment risk is something we think a lot about. So we're very comfortable owning, 5 to 10 businesses. They will be at varying levels of concentration over time. We do trim as the intrinsic value reaches, the sort of trading value, but that can take years to play out. And so we're not too often actively trading just to look like we're doing things or just reacting to prices. We're letting things kind of play out on a quarter-to-quarter basis.
Yeah. What kind of holding period do you often have? You typically, I mean, is it range? Do you do short-term positions, or is it typically a longer-term play that you hold the stock for a while?
Yeah, I mean, from a tax efficiency point of view, we obviously want to hold for multiple years. Amazon is a position that we've held really since inception. We still hold it today. There are other positions that maybe we've owned for 1 to 2 years, but the narrative changes, or we feel less comfortable with the direction of the company relative to another position that we might want to reallocate capital to. I think when we underwrite an investment and we really think about establishing a position, we're doing so because we believe in, let's say, the 3 to 5 year potential trajectory of the business. So in that sense, we're long-term minded, but I would also say that term gets thrown around pretty often. And I think long-term investing is really just like a series of day-to-day decisions, and where often the consequence of those decisions is to do nothing, and it leads to inaction. But that's how we kind of think about, long-term investing. When we underwrite a position, we want to believe that over the next 5 years, this position can really compound out at like, at least 20% a year, but really higher than that ultimately.
Yes. So you guys had an incredible year in 2020. I think both your funds were up over 200%. Is that right?
Yeah. Yes. We had a very strong year in 2020, like almost absurdly strong. But I would just say our performance, I think, really goes back to 2012 on the long only strategy. We've had a 5-year track record on the long short. Given the levels of concentration, we will be volatile from month to month. That's really like a feature, not a bug of our strategy. Yeah. And so we're looking at like a 10-year horizon. So yes, we had a great year, but at the same time, we don't think too much about it because these things swing around, and we're just trying to put the best portfolio together today for the future every single day. That's kind of what we're focused on.
So that makes a lot of sense to me as a fellow investor, kind of wanting to have that headset of, it's not what I did yesterday that matters. But I'm curious, externally, did perceptions change, from the people that you're talking to, the allocators who maybe would have laughed you out of the room for, being long Tesla a couple of years ago? Are you, getting return phone calls from them? Are you kind of experiencing any sort of tone shift in the tone that these conversations are having?
Yeah, no, we've been fortunate to have really productive conversations with very smart institutional allocators. I think that there may be a feeling among some of them that they've missed. So that's the irony, I guess, is that that they feel like it's over. Obviously, I think we're really in the early stages of what the long-term opportunity is. Did we get, callbacks? Yeah, there was certainly more interest, and we've been very fortunate to introduce some new partners into our strategies over the last year or so. But we're actually not all that concerned, with finding new partners so much as finding really quality partners. Because of our long-term vision, and it just necessitates people who really get what we're doing, and can look at us as like a 5-year investment, because we're going to be, month to month kind of moving around quite a bit. That's how we've historically been able to get, the returns that we've delivered to our partners. But yeah, it's funny, even recently, still getting the same criticisms and same pushbacks on Tesla that I got 4 years ago. It's funny.
It still makes me laugh every time I hear the competition is coming. I'm like, really? Like still, like we're still hearing that? But it seems like the same, the short thesis from 8 years ago is like still being, bandied about today. It's kind of surprising.
But again, like that's great. The second that the short thesis becomes really compelling to me on a personal level is when I think it requires you as an investor to really do some deep reflecting on it. But yeah, we've gotten, it's so overvalued. I think that argument was made really since I think it IPO'd, like over 10 years ago at this point. So it's funny to me that people would say it's overvalued and continue to say that without ever really reflecting on what a true valuation should be for this company. I think that's the interesting thing to me is you can hear a criticism that says it's overvalued, but you very rarely hear what those people believe it should be valued at, what sort of multiple it should trade at, or what they think the opportunity set is, or on a qualitative level. You hear the same stuff about car quality, but you never hear anything about the software or FSD or anything. And I know, Matt, that you've experienced it. And I appreciate your comments on Twitter that I think you're pretty open about some of the limitations, but relative to the other car manufacturers that are producing this technology, I'd still say that there's a pretty significant lead that Tesla has over its competitors. But yeah, we get pushback still. It's never an easy position, that's for sure.
Yeah, no, absolutely. I know you prefer to be, kind of long-term thinking about, all your positions, but I'm curious if you have any thoughts on kind of, the macro market in general, and, maybe Tesla in particular. You've seen, certainly an increase in volatility and, and seemingly kind of an increase in uncertainty around some Fed policies and inflation and how might that impact, kind of the sandbox, a lot of these high growth disruptive names that we both play in. What are your thoughts on kind of the macro market and kind of recent stuff that we've seen?
Yeah, I talked with Arnie about this, and his attitude is always, there's a wall up around the market, right? Money's got to go somewhere. So even if money goes on the sidelines in the short term, whether it takes a couple months, a couple quarters, I think that money has to stay in the market. I think relative to bonds or, the interest rate sort of question doesn't concern me too much over the long term. I think obviously it's led to some shorter term volatility. But I think if you do really genuinely take a 3 to 5 year time frame perspective, it shouldn't be all that concerning. That said, anything can happen in the short term, and I just choose not to really think or try to believe that I have some crystal ball on where macro markets are moving. And I'm guessing you guys maybe feel similarly, but be curious to get your perspective on that. I mean, obviously it can work to your benefit as well. I mean, you could see more trade opportunities if you're willing to kind of lean into any perceived potential movements in the overall market. But our edge sort of decays the shorter time frame that you get. I think our edge expands if you kind of expand the time frame. And so that's kind of where we like to play in terms of just the position sizing and the sort of duration of our investment thesis. We like to give it at least a couple of years to play out.
Yeah. What are your thoughts on, I guess, Tesla in particular? I mean, macro market aside, I think we sort of agree that it's very hard to predict short term, and we believe whether the cash goes on the sidelines or it's going to come back to the market, to the stocks at some point, in some way, shape, or form. We think too, in time. But for Tesla specifically, most of the people that follow us for Tesla, and you guys are bulls on Tesla. Just a couple more questions on that is, I mean, we're at $1 trillion market cap approximately right now. Where do you see, have you guys projected into, 5 years or 3 years, anything like, any thoughts on what you think the market cap could achieve in that time frame?
Yeah, I mean, we do have like a 5-year analysis and a price target pegged towards really 2026. I choose not to really reveal those publicly, just because I think that's really for the benefit of our partners. I will say though that we believe that it can be multiples higher than it is today. I think setting aside some of the short-term movements in the stock, there are some pretty fundamental catalysts to the business that I think are not fully appreciated just yet. We have 2 factories opening. We have installed capacity run rates that today probably, 1 million cars in Shanghai alone. I think that you're going to see the automotive gross margins continue to improve as the manufacturing processes also improve. So yes, on a risk-adjusted basis, it's, we've been public about this before. It's our largest position based purely on the fundamentals. And we obviously believe that it can compound out at significantly attractive rates going forward. The $1 trillion market cap, I think that seems, there's going to be a lot of $1 trillion companies pretty soon. I think over time, I think we're going to see a consolidation of a handful of select winners taking market share away from, sort of the mid-size or smaller companies. I think that this is a general market perspective that I have and that our firm really expresses, which is we're entering into a winner take most type of dynamic across several industries. Transportation and energy, certainly we think is one of those industries. And so is it, even on a 2030 basis, when you start penciling out the numbers and thinking about the potential lotto tickets or optionality of Tesla, everything from robotaxi to Tesla energy, trucking, there's just so many ways to win here. And even without any of those elements, I think that you can make the case that just on a pure even price to earnings ratio, on a forward ratio, it's still an attractively priced company. So you're just not going to find companies growing at a production rate of 50% a year for the next 10 years trading at this level. So that's what I always come back to, and it's you get to participate in probably the most fascinating growth story of our era. And I love that there's still bulls, and there's still bears and shorts on it. I think that's great. I think that
Yeah, we were just talking right before we started recording about that a little bit, about how it's a good sign when you talk to someone in the kind of institutional space and they're still somewhat skeptical of Tesla. That's sort of a really good sign for us Tesla investors, I'd say.
Yeah, I'd agree with that for sure.
Yeah, I think a lot of the conversations that we do have where, there's some kind of concern expressed, it generally seems to be like some sort of vague concern that like, oh, there's only so many $1 trillion market cap companies out there. And, Tesla's revenues seem pretty small to justify that. So like, really, how can you like get comfortable that it'll, 2-3x from here? Yeah. But my thinking, just like you're talking about, Eric, is like, if you take a forward PE and you actually do the work on like what they're reasonably likely to achieve just in the short term, that in my mind is a very good backstop in the current price. And then you've got like huge optionality on all these, other businesses that they're, kind of just creating out of thin air. And like, I mean, all the real world AI potential that is hard to even really fathom right now, let alone like financially model, is, just probably the biggest one of all, and it's like the hardest to really pin down. So like if you can get to like a 2-3x or more from like robo-taxi potential, and then you start adding in Tesla energy and like the things that you can actually identify, create Tesla maybe a 5x opportunity. Yeah, and then you got all like this like weird ether of all these other like potential things that they could do, and it just gets really compelling. But you don't. At a lot of the conversations that we have, like people will just discount that entirely, or just are like not interested in the details. I don't know if you found something similar.
Yeah, look, I think that you have a very, I think I've described him before as charismatic techno king, no longer CEO, but techno king. And I think that we live in a very media saturated world where it's very easy to get distracted by noise on any position, any company, but especially Tesla. And I think that's been the case. That I think that they're from an institutional investor perspective, Elon himself and maybe how the business is run is considered non-traditional. And so there's a fear about the unknown. From my perspective, I look at, where do the top college grads want to go to work? They'll want to go work at SpaceX and Tesla. It's an innovation factory. And I think that those are the inputs and the pieces of signal that people can, and I think should focus on, which is, on the ground level, what are customers saying, what are employees saying, what's actually happening at a business level. And, there was, I think people kind of laughed or poked fun at the Tesla bot suggestion. I take it somewhat seriously. It's certainly not a short-term type of initiative. But when I've spent, and I know you guys have as well, I've spent years studying Tesla's approach to autonomy and the neural net and their general approach to full self-driving. There are other applications of this system that have industrial application and also consumer application, right? So I think that if you are willing to take a longer term perspective and willing to do the work of understanding what you're hoping to achieve with this platform, I think it's pretty eye-opening about, there's only a handful of truly, innovative, fascinating companies in the world. I think that this problem around autonomy and just general AI, I think will increasingly become part of the thesis behind Tesla. Of course, that's my opinion. That could be, I could be off. But like you said, Matt, I mean, there's always just the backstop of this is a business that's just growing at an accelerating rate, and the margins are improving. There's clearly no demand issue, so it's truly like from my opinion, a must own. Like I just can't see how as an institutional allocator you just don't own it. I mean, it just seems like a generational type of company. Like in 30 years from now, it'll be crazy to not have owned it during this period. That's my opinion.
We agree. Yeah.
Yeah, we definitely agree. And there's some more I want to get into with Tesla as we talk about the energy side. But maybe before we do that, can we talk about another one of the names that you guys are really bullish on, but that Emmet and I think just don't know as much about? And that's Spotify. So maybe could you kind of lay the bull case out there, and we'll have a couple other kind of questions we can drill into.
Yeah, Spotify is an incredible company in my opinion. Daniel Ek, the founder CEO, is really on a mission to prove to the world that audio is really a $1 trillion opportunity. Much more than just music. Audio means everything from podcasts to audiobooks to live talk, radio, everything. So, our opinion on Spotify, it's still very early stages. There are some similarities to Netflix, in which initially the market perceived it as somewhat, structurally unprofitable. The valuation made no sense. There were no earnings. Over time, margins improved as the audience grew, and there were new ways to increase operating leverage over the platform. So the big picture for Spotify is, right now it's about 400 million users. Over the next 5-6 years, we think it can grow to 1 billion users, with potentially more than 50 million creators on the platform. I think that there are very few platforms or companies in the world that can claim to have 1 billion users. I mean, really, you can count them on basically 2 hands. And so when thinking about sort of the probabilities and risk reward scenarios, to us, at least, Spotify is increasingly one of those great Tesla-like opportunities. Before we did this call, I started thinking about some of the similarities that Spotify has to Tesla. And it's certainly not obvious on its face, but I think that one of the sort of, I guess, key ideas to think about with Spotify is that in the short term, the margins don't look great. And I think you saw that with Tesla as well. If you look, 2017, 2018, margins did not look good. But I think what maybe the misperception is that with scale and with a continuing reduction in cost, you actually get to much more attractive margins in a shorter time frame than maybe other market participants believe. So for Spotify, that's building out a huge advertising business that I don't really believe is reflected in the current quote today, which is a high margin business. And then you have all of these other sort of optionality side bets, from monetization through direct subscriptions on podcasts, the two-way marketplace, even creators selling direct merchandise on the platform through the recent partnership with Shopify. So there's many elements to the story. And it's funny, I mean, I was speaking earlier today with another analyst on Spotify, and he said, been working on Spotify, and it's funny, like, it's a company where within the first 10 minutes, the bear case is totally known. Like, everyone knows the bear case. And the bear case is very simple. It's that Spotify pays out too much money to the labels, and they'll never actually be profitable. And it's always going to be handicapped by this relationship with the labels. And I think that my emphasis and what we've done is, I think if you dig a little bit deeper and scratch beneath the surface there, you realize that what the platform is building is kind of the Google of audio, just the general audio search platform on which creators can monetize and advertisers can potentially reach new audiences, which is an incredibly value additive platform, and one that I don't think is truly well understood by the market. But it could take a couple of years. We could be wrong. All the normal caveats that I want to mention. But yes, it's another big position of ours that we're pretty excited about.
So, I think there's a perception among many, and probably I've got the residuals of this perception in my mind. When Apple kind of launched the podcast, it was really kind of just a service for the customer that wasn't really, highly monetizable by Apple at the time. And so I think there's probably no shortage of investors who kind of see the same thing of like, well, you try to squeeze some money out of this thing that has historically been free, and you're either going to upset the listeners, or, the margins are just going to be too thin. So can you maybe walk through that thesis a little bit of how is monetization going to change from, what has historically been kind of like a commodity business with maybe some annoying ads to something that can be, really structurally profitable in a way that we haven't really seen historically?
Sure. It's funny. I mean, I think structurally the incumbents should have an advantage in business. I mean, so Exxon really created the first battery. General Motors really built kind of the first of this era electric vehicle. Apple really kind of invented podcasts, right? But it wasn't those companies that necessarily led the real value creation. So like, I think that the big thing to focus on with Spotify and its podcasting platform is there is an incredible, I think, underexplored area of just internet creation and monetization in general. I mean, you guys, I think, have studied this maybe with Roblox a little bit, but it's, if you can create a platform on which users spend a significant amount of time both creating content and consuming content, you can find additional ways to monetize and leverage that relationship over time. It's in the short term, you certainly don't want to squeeze your customer for, incremental profit, right? You want to just incentivize them to stay on the platform, to create. A friend of mine has a great kind of expression for Spotify, which is that they're creating the operating system for creators. This is a very crowded space, I would point out. I mean, this is a very competitive area right now. And I think maybe your next question will be, well, isn't YouTube doing something similar? Or, certainly Amazon is now coming into the podcasting space. And I think, yes. And I think the reason is because there's a recognition that the audio landscape generally has historically been quite small as a result of radio just being sort of linear. It's been a tough platform to really monetize through targeted advertising. But the real innovation, I think, that's happening at Spotify is the ability to target individual listeners based on their hobbies, preferences, and allow advertisers to connect with those audience members. And then also allow creators to expand their total fan listenership on the platform itself. And that kind of comes back to, once you have 1 billion users on the platform who are highly engaged, it becomes a great flywheel effect of attracting more creators because it's the best platform to find new fans, and you can kind of keep going on there for forever. And I think in some ways you probably see that with Roblox. I certainly think it's the case maybe for even a platform like Airbnb, which we own, which is the more creators are on the platform, the more inventory you create, the more demand results from that because of all the great supply that exists on the platform. So yeah, I suppose the way I think of Spotify is, right now audio is really perceived as commoditized music, and I think that's kind of the knock on it, and so that's the bear case. The true long-term bull case is that audio is much bigger than just music, and there are additional ways to leverage and monetize the platform beyond what we're seeing today. And over time, margins will improve through a variety of initiatives that the company is working on.
Yeah, what I like about Spotify is it sort of tries to aggregate all the different, make it open source, and that it can aggregate all the different types of podcasts, into the Spotify app easily. It doesn't try to create some kind of, walled garden of audio. Do you think, I'm so green on the whole Spotify business model. This might be a silly question, but do you think there's any chance, like I listen to a lot of YouTube videos I don't watch them because I'm like, walking or going for a run or exercising or in the car, and I'll listen to podcasts, but I'll also listen to audiobooks, or I'll listen to YouTube videos. I don't necessarily need to watch a YouTube, like this might be on your YouTube channel, but people might listen to it, or it's also going to be on our Spotify. It'll be channel 2. But do you think YouTube, is there a way for Spotify to build a bridge to the audio of YouTube channels, or do they already do that? Certain YouTube channels like ours is broadcast across a lot of, podcast, mechanisms already, but for the YouTube channels that are there, that are just YouTube channels that aren't broadcast across different mediums, can Spotify build a bridge to have the audio of that, do you think? Or
I think it's possible. I think more likely is that Spotify will continue to work on its video platform as well, to enable creators to really have a choice to do just audio or just video. I think another interesting element, and maybe you guys would appreciate this, given that you do both video and audio for your work, is I find personally just that there are fewer barriers to entry for audio. If you're including video, you have to be sitting at a desk, you have to be recording, you have to have a nice background, you have to take a shower, all this stuff. And so it limits the amount of content creation, right? There is that force function of, you need a camera, you need a scene, you need to maybe edit it a little bit here. But when I think about what Spotify is doing, and I think you guys may use Anchor as well, and if not, I certainly recommend checking it out, is just the ease of content creation, just audio. I think that is another underexplored element, which is if the goal is to just increase the amount of great content that exists on a platform, you should make it really easy for creators to just create. And maybe video is a great modality of communication. I watch your videos. I watch, plenty of I love Rob Maurer's videos on YouTube, but then there's other stuff that I think is just much better to listen to. From an audio, it doesn't need video. In fact, video might slow it down. And maybe from a creator perspective, you're kind of handcuffed a little bit. You're tied because it's just slower to create and it limits the amount you can actually of output. So that said, I mean, Spotify now offers podcasters the ability to publish video. So I think it will be increasingly sort of a mixed medium. I think long term, Daniel Ek has already talked about expressing content through AR and VR. And so I think that, audio may become more fluid than it is today.
Yeah, it's interesting. I was just, as we were talking here, kind of thinking about my own kind of use of all these different media applications. And I realized that on a regular basis, I'm using Apple Podcasts, Apple Music, Amazon Music, Audible, Spotify also, and then YouTube Premium for audio only. And it's kind of annoying to shift back and forth between those. And I personally want just one of those platforms that I can always go to. I do think Spotify honestly has the best kind of user experience just as a listener. It's got such a great search function where if you want to find one individual, you can find them across any, podcast that they've ever appeared on. And there's just a lot of things about the user experience that I think is really kind of great. So I'm curious, do you see kind of users consolidating into one of those platforms and Spotify kind of being that winner, just as people kind of migrate away from all these kind of disparate sources of audio in the future?
Yeah, I mean, rather than prognosticate, I'd say, today Spotify is the winner. I mean, in terms of paid subscriptions, Spotify is leading, and I think that's a reflection of just the amount of incremental work that the team has done on the platform and making it really sticky. I mean, from from an investment perspective, I mean, the churn rates are really low. I think that there's a ton of flexibility in terms of raising prices, but in the short term, keeping people on the platform is kind of the number one goal. And whatever they can do to express that is absolutely what they're going to work on. But I agree with you. I mean, I think that there probably are, if you think about even in the early days of Google search, it wasn't just Google search, right? It was pretty fragmented across Ask Jeeves and Lycos, and there were a host of other search engines, right? And ultimately, it was a winner take most type of dynamic because there's some power laws that accrue to the winners of these shifts, where as Google gets bigger and the Google search gets bigger, the power of the platform becomes stronger. And I think that there are some similarities to what we're seeing on Spotify today, which is as the platform gets bigger, as there's more listeners, there's more data, so that advertisers can better segment, and also creators know how to segment their fans more appropriately. So there's just this sort of flywheel effect that there's definitely a race right now. And this is Spotify's number one focus. I don't think you can say the same for Amazon or Apple. I certainly think that these are worthwhile competitors, and it's great to have this competition because I think it indicates that there is a much bigger, prize at the end of this journey. But I much prefer owning the platform that makes it their number one obsession and is kind of winning with customers on the ground level.
Yeah. So one last question on Spotify I have is they seem to have taken a stance either in support of free speech or kind of, I don't know if you'd even say anti kind of woke mentality. But where you do see some kind of censorship on a lot of these other platforms, the fact that they picked up Joe Rogan and are basically just totally hands off. Whatever he says, they're basically fine with just letting him say it. Is that an important piece of the investment thesis in your mind, or how do you kind of think about their stance on free speech?
Yeah, I remember a couple of years ago, Netflix dealt with something relatively similar, which was, I think, we can go back and look at this, but at the request of some government, they started removing some content. And I think that this is just a natural consequence. I mean, Facebook and Meta deals with this question constantly of how to police content on platforms. I generally try to stay pretty agnostic towards these decisions and kind of let the operators of the businesses that we own just kind of make these decisions. I take a somewhat dispassionate take or dispassionate view on this, which is I don't think it really affects the investment case either way. And so whatever our CEOs and management teams think is the appropriate course, that's probably the right thing to do. You know, as far as like what sort of content should be policed or not policed, again, I don't think it's material to the investment outcome decision or just the investment thesis. So I'm kind of hands off on that.
That makes sense.
And I know one last thing. I know on Spotify, I know like you mentioned in a past interview you've done, I've listened to the advertising, advantage that Spotify could potentially have. Like I think there was an example of a commercial for betting on sports, and there's so many states that don't even allow it, but it's still most podcasts, they can't differentiate, but Spotify can. Can you explain that a little? I mean, this seems like a unique advantage Spotify does have, right?
Yeah, absolutely. I mean, so I'm not sure many people know this, but Spotify acquired Megaphone, which is I would simply describe it as the number one podcasting platform for creators and advertisers. Through Megaphone, they have a partnership with Nielsen, and it's pretty unprecedented, but through this relationship, advertisers get a very granular picture of IP addresses of where people are actually listening to content. And you can cross-reference those IP addresses with other formats and kind of figure out who your listener is. When you compare that to, let's say, traditional radio, it's, you put an ad on radio and then you target Phoenix, and that's pretty much all you can get. And you don't know who listened to it, and you're just kind of winging it. But radio advertising existed for many years because it was kind of the best that existed at the time. But I think that I take a more holistic view here, which is, my background in journalism, the newspaper model was totally disrupted by Facebook and Google because advertisers just had a much better way to actually, find their audience. And so that's certainly, I think, the case going to be for radio, which is you're going to see a huge amount of ad dollars shift over to streaming. But because we're so early in the stage, I think it actually grows much larger than radio. I think that I think over time, and Don Ostroff, who is an executive at Spotify, has been on record saying that they are increasingly competing with the likes of Snapchat and Twitter for advertising dollars on Spotify because of how robust their segmentation engine is. And I think that's an increasingly important part of the business. And let's not gloss over the fact that this year Spotify will do about $1 billion in ad revenue. I mean, in the Q3 call, Daniel mentioned that over time, total ad revenue will be at least 20% of the business, but maybe 30 or 40% of the business. So if you actually run the numbers and even assume a pretty modest top line growth on the premium side of the business, and back into some numbers on what advertising could be, at scale, it's a very meaningful size business with very healthy gross margins. I think the market and maybe the sell side approach is not really placing much emphasis on that growth. But we'll see over time, if that thesis plays out. And I think over time, you'll see more advertisers migrate to the platform because of how, kind of targeted these advertisers can get.